People ask me all the time what the secret is. They fly in from Tokyo, from London, from Sao Paulo. They sit across from me at this old wooden desk in Omaha. Not exactly Wall Street, not exactly a skyscraper with marble floors and a receptionist who makes you feel small, just a modest office above a furniture store. The same office I've sat in for 60 years, and they expect me to hand them some kind of formula, some elaborate algorithm, a Bloomberg terminal with 17 screens showing signals and triggers and moving averages. Instead, they find an old man with a cherry Coke reading a printed annual report with a highlighter. And I look up at them and I say, "You want to know the real secret to never worrying about money again? Stop trying to get rich. Start building a machine. Because getting rich is a one-time event. Building a machine is a lifetime event. There's a difference between a man who wins $10,000 at a casino and a man who owns the casino. The man who wins goes home, spends it, and comes back. The man who owns it goes home, goes to sleep, and wakes up richer than the night before. I have spent over 70 years building one kind of machine in particular. Not a software machine, not an algorithm, not some trading system that requires me to watch a screen every morning. A dividend machine, a system where living, breathing companies that make products people use every day, companies with pricing power and loyal customers and decades of consistent earnings send me checks every single quarter whether I lift a finger or not, whether I am asleep, whether I am at lunch, whether I am sitting in this chair reading or lying in a hospital bed. The checks come, and today I am going to give you the exact framework I have used to build that machine. Not the simplified version, not the version they put in magazines, the real rules, the ones that actually produce $10,000 a month in passive dividend income and eventually a great deal more. There are 5 of them. They are not complicated. That is the first thing I will tell you, and the last thing I will repeat. These rules are not complicated. You do not need a finance degree. You do not need a Bloomberg terminal. You do not need to understand derivatives or options chains or yield curves. What you need is patience and the willingness to be boring. Most people are not willing to be boring. That is why most people will never build this machine. The whole game of dividend investing is a game of disciplined, almost meditative patience. The sexy version of investing, the version they sell on social media, the day trading, the crypto moonshots, the options plays. That version is exciting the way a car crash is exciting. Lots of noise, lots of movement, and at the end of it, someone is bleeding on the pavement. This version is different. This version is quiet. It is slow. It is, to the untrained eye, profoundly unimpressive. And it will change your life completely. Pay close attention. Let us begin. Stop. The first rule I call the Golden Goose Rule. And before I explain it, let me tell you something about human beings. We are extraordinarily good at killing the things that will save us. There is an old story, a fable from Aesop, thousands of years old, about a farmer who owns a goose that lays 1 golden egg every single morning. Every morning, without fail, the goose walks out of the hen house and there is a golden egg sitting there on the straw. The farmer sells the egg, buys food, pays his bills. Life is comfortable. But one morning the farmer wakes up and has a thought. A logical thought, by the way, a seemingly intelligent thought. He thinks if this goose lays 1 golden egg per day, then inside this goose there must be an entire supply of golden eggs. What if I just cut the goose open and take them all at once? So he does it. And of course, there are no eggs inside. There is nothing, and the goose is dead, and the golden eggs stop forever. I have watched this happen 10,000 times in the world of investing. A person builds up through years of saving, through sacrifice, through the kind of quiet, grinding discipline that nobody celebrates. They build up $100,000, $200,000, sometimes more. And then they look at it and they think, this is money just sitting here. I should put it to work. I should do something with it. And they do something with it. They buy a boat. They put it into a startup that a friend pitched them. They use it as a down payment on a vacation property they rent out 3 times a year and call a business. They take a trading course and spend 6 months losing 40% of it in the options market. They kill the goose. Here's the truth about dividend investing, the single most important truth I can give you before we go any further. Your capital is not your wealth. Your capital is the machine that produces your wealth. Those are two completely different things. When you have $100,000 invested in dividend-paying stocks that yield 5% annually, you do not have $100,000 of wealth. You have $5,000 per year of perpetual income every year, forever, as long as you do not kill the goose. That is the mental reframe. That is the operating system update you need before anything else. Most people look at $100,000 and think about what they can buy with $100,000. I look at $100,000 and I think about what it will produce every year, every decade, every generation. 99% of my net worth was accumulated after my 50th birthday, not because I got lucky, not because I made a brilliant trade, because I did not kill the goose. I let it lay eggs, and then I let those eggs hatch into more geese, and then those geese laid more eggs. That is the whole game. Here is the math. $100,000 yielding 5% gives you $5,000 a year in dividends. That sounds modest. Most people would be unimpressed by that. But here's what happens when you reinvest those dividends, when you do not spend them, when you let the eggs become more geese. At 5% yield with reinvestment, your $100,000 becomes $200,000 in roughly 14 years. Then it becomes $400,000 in another 14. Then $800,000, then $1.6 million. And at $1.6 million producing 5%, you are receiving $80,000 per year in dividend income without touching a single share. That is $6,600 a month from $100,000 and the simple act of not killing the goose. Add regular contributions, even modest ones, even $500 a month, and that timeline compresses dramatically. You are looking at $10,000 a month in passive dividend income within 20 to 25 years. That is not a fantasy. That is arithmetic. Here is your assignment for this rule. Tonight, I want you to write down the current value of every investment account you own, every retirement account, every brokerage account, everything. Then beside each number, write down what it produces. Not what it might be worth someday, what it produces right now. How much does it pay you in dollars per year, per month? If the answer is zero, you do not have an asset. You have a lottery ticket. Start asking differing questions about your money. The second rule I call the dividend aristocrat standard. And I want to explain why this matters more than almost any other piece of criteria in the whole analysis. When I was 21 years old, studying under Benjamin Graham at Columbia, my teacher, the man who fundamentally rewired how I think about markets, he taught me something I have never forgotten. He said, "Warren, price is what you pay, value is what you get. And the best kind of value in a business is not found in the balance sheet. It is found in the behavior management over decades. Decades. Not quarters, not years. Decades. A company that has raised its dividend every single year for 25 consecutive years or more, which is the standard required to be called a dividend aristocrat, is not a lucky company. It is not a trendy company. It is not a company riding a temporary wave of popularity. It is a machine to pay a rising dividend for 25 straight years, through recessions and market crashes and oil shocks and pandemics and wars and interest rate cycles. That means the underlying business has durable pricing power. It has a genuine competitive advantage. It has management that thinks in decades, not quarters. It has the kind of financial strength that does not collapse when a storm arrives. Let me give you a character study here because this is important. Imagine two investors, both 30 years old. We will call them Sarah and Michael. Sarah buys a high-yield stock, one of those companies yielding 9 or 10% that catches her eye on a financial website. It looks incredible. On paper, 10% yield sounds like the answer to everything. She puts $50,000 in. Michael buys Johnson & Johnson. Boring, predictable, unsexy Johnson & Johnson. Its yield at time of purchase is 3%. Sarah actually laughs at this. 3%, Michael. My stock pays 10. Here is what happens. Sarah's high-yield stock, which was paying out more than it could sustain, a phenomenon called the dividend trap, cuts its dividend 18 months later. The stock price drops 40% simultaneously, because dividend cuts and price drops are twins. They always arrive together. Sarah has lost not just her income, but 40% of her principal. The machine is broken. Michael's Johnson & Johnson raises its dividend. It has done this every single year since 1963. 61 consecutive years of dividend increases. The 3% yield he bought at is now yielding him 8% on his original cost basis. Because the dividend has grown every year for 6 decades, his stock price has also grown. He has not lost sleep a single night. This is the trap most dividend investors fall into, and I want to be brutally clear about it. A high yield is not a reward. It is often a warning. When a stock yields 9% in a market where the average dividend payer yields 3%, the market is telling you something. The market, for all its manic depressive behavior, for all its overreactions and panics, is not stupid about one thing. It is not stupid about one thing. It is not stupid about risk. A 9% yield usually means the market does not believe that dividend is safe. The stock price has been beaten down because sophisticated investors are pricing in a cut. And they are usually right. The number I look for is not the current yield. It is the dividend growth rate. How much has this company raised its dividend per year, on average, over the last 10 years? A company with a 3% yield that grows its dividend 8% per year will yield you, in 10 years, 6.5% on your original investment. In 20 years, over 14% on money you put in 20 years ago. That is the machine working correctly. That is the golden goose laying more golden eggs every year. Here's your assignment for this rule. Go to any financial website and search for the Dividend Aristocrats list. There are currently 67 companies on it. I want you to spend 1 hour reading through that list. Not analyzing financials yet, just reading the names. Notice how many of these companies make products you used this morning. The toothpaste, the detergent, the ketchup, the soda, the medication. These companies have been raising dividends through every crisis of the last 25 years. That is not an accident. That is a moat. The third rule I call the payout ratio ceiling. And this is where things get slightly technical, but I will make it simple because it is simple. There's a number that every dividend investor needs to know cold before they put a single dollar into any company. It is called the payout ratio. And it is just this: what percentage of the company's earnings are being paid out as dividends? If a company earns $4 per share and pays $2 per share in dividends, the payout ratio is 50%. If a company earns $4 per share and pays $3.80 in dividends, the payout ratio is 95%. Here is why this matters more than almost any other number. A dividend is only as safe as the earnings that support it. Companies do not pay dividends out of goodwill. They pay dividends out of earnings. And if the earnings decline, which happens, business is cyclical, this is the nature of commerce. A company with a 95% payout ratio has almost no cushion. The moment earnings dip 5%, the dividend is in danger. The moment earnings dip 10%, the dividend is in danger. And when the dividend gets cut, as I told you, the stock price follows it down. But a company with a 50% payout ratio, earnings can fall 30, 40, even 45%, and the dividend remains intact. The machine keeps running. The goose keeps laying. My general ceiling, the rule I have used for decades, is 60% for most businesses. For certain business types, real estate investment trusts and utilities and pipelines, the structure of the business allows for higher ratios sustainably. But for a standard industrial or consumer goods company, if the payout ratio exceeds 60%, I grow cautious. If it exceeds 75%, I walk away no matter how attractive the yield looks. Let me put a number on what this discipline prevents. In 2009, during the financial crisis, dozens of large, well-known American companies slashed or eliminated their dividends. General Electric, a company most people considered about as safe as any company on earth, cut its dividend by 68%. The stock fell over 50% in less than 2 years. But Coca-Cola, with a payout ratio that had always stayed conservative, raised its dividend in 2009, during the financial crisis, while the world was collapsing around it. I have owned Coca-Cola since 1988. I paid roughly $10 per share, adjusted for splits. Coca-Cola's current annual dividend is approximately $1.94 per share. That means every year, without touching a single share, Coca-Cola pays me nearly 20% of my original investment back in pure cash income. That is a 36-year-old machine still running perfectly. The payout ratio when I bought it was sustainable. I checked. I always check. Here's the cruel paradox that most amateur dividend investors never figure out. The stocks that look the safest, the ones with the highest yields and the most attractive income, are often the ones with the most dangerous payout ratios. They are the ones where management, under pressure to maintain the dividend to prevent a stock price collapse, has painted themselves into a corner. They are paying out more than they can sustainably pay. It is like a man spending from his savings account every month to maintain a lifestyle he cannot actually afford on his income. It works until it does not. And when it stops working, it stops suddenly and painfully. Here is your assignment for this rule. Pick 3 dividend-paying stocks you currently own or are considering. Look up the payout ratio for each one. If you cannot find it in 30 seconds on any financial data site, the information is failing you, and I want you to fix your research tools. Write down the 3 payout ratios. If any of them are above 75%, I want you to ask yourself what happens to this dividend if earnings fall 20% next year. Because earnings fall 20%. It happens. It has happened to every business on earth. The question is not if. The question is when and how prepared are you? The 4th rule I call the reinvestment engine. And I will start this one with a confession. The most powerful force I have ever encountered in 70 years of investing is not market timing. It is not stock picking. It is not any kind of analytical framework or intelligence or skill. It is reinvestment. The act of taking the income your machine produces and feeding it back into the machine instead of spending it. Einstein. Whether he actually said this or not, I cannot verify, but the mathematics are undeniable. Einstein supposedly called compound interest the 8th wonder of the world. And the reason is this. Compound interest does not add, it multiplies. And the difference between addition and multiplication over a long enough time horizon is the difference between comfortable and extraordinary. Let me show you the number that most people never calculate and most financial advisors never show you because it is almost embarrassingly powerful. Imagine 2 investors, both starting with $20,000 at age 25. The first investor, let me call him Thomas, takes his dividends as cash every quarter. He has worked hard. He has saved this money. He deserves to enjoy the income it produces, he tells himself. Every quarter he takes the $800 or so in dividend payments and spends it. Nice dinners, a weekend trip, small pleasures. The second investor, let me call her Ruth, reinvests every dollar of dividends automatically. She never sees the money. She has set up a DRIP, a dividend reinvestment plan, and every quarter her dividends automatically purchase additional shares of the same companies. She lives on her salary. The machine is left alone to compound. Both investors earn 7% total return. Both retire at 65. Thomas has approximately $217,000. Ruth has approximately $480,000. Same starting amount, same time horizon, same rate of return. The only difference is that Ruth let the eggs become more geese, $263,000 difference. From one decision made once and maintained consistently for 40 years. That is not a trick. That is not financial sorcery. That is the mathematics of reinvestment. Now here is where it gets interesting. Most people understand this in theory. They nod. They say, yes, of course I should reinvest. And then the quarterly dividend arrives and they have a car payment due and the money is right there and, well, just this once. The enemy of the reinvestment engine is not ignorance. It is what I call the reward trap. After a period of sacrifice, after the months or years of saving that built the initial capital, the brain demands compensation. It is biology. It is the ancient reward circuitry of the human mind that says, I have done the hard thing, now I deserve the good thing. And the dividend, arriving in your account on a predictable schedule, presents itself as the reward. You must not let it be the reward. Not yet. The reward comes later. The reward comes when the machine is large enough that you genuinely can live on the income it produces without touching the principal. The reward comes when $10,000 a month appears in your account, not because you sold anything, not because you worked for it that month, but because you own pieces of companies that generate real cash and share that cash with their owners. That reward is worth waiting for. The quarterly spending of your dividends, before the machine is big enough, is the equivalent of a farmer eating his seeds in winter. It feels satisfying. It addresses an immediate need, and it guarantees that there will be nothing to plant in spring. The automation of reinvestment is the single most important structural decision you can make right now, not because it requires discipline, It actually removes the need for discipline by removing the decision entirely. When the reinvestment is automatic, when you never see the money, when it simply rolls back into additional shares of the same great companies, you eliminate the moment of temptation entirely. I have never once had to resist spending a dividend that was automatically reinvested before I had a chance to think about it. Here is your assignment for this rule. Log into every brokerage account you own, find the dividend reinvestment setting, turn it on. If your broker does not offer automatic DRIPE dividend reinvestment plans, I want you to consider whether you have the right broker. This is not optional. This is the engine of the machine. A machine without its engine is just furniture. The fifth rule I call the patience tax. And I say this as the most important rule and the hardest rule, and the rule that almost every investor understands intellectually and almost no investor actually executes. Here is the brutal truth about dividend investing. It is boring for a very long time before it is miraculous. The snowball starts small, painfully small, comically small. You put in your first $10,000 and it produces $41 in dividends the first month, and you look at that and you think, this is what I sacrificed for? This is the machine everyone talks about, and then your friends are talking about the crypto coin that tripled last week, and your coworker made 30% in 3 months on a momentum trade, and social media is full of people who turned $5,000 into $50,000 in 6 months, and they have the screenshots to prove it, and the machine sits there, quietly, producing $41 a month, and then 43, and then 46, growing so slowly that on any given month you cannot really see it moving. This is where most people abandon the machine. This is where most people either sell, chase something exciting, or stop contributing because the results feel insulting relative to the stories they are consuming. And this is the single most expensive mistake in the entire game of wealth building, because what they are abandoning, at the precise moment they abandon it, is the early phase of an exponential curve. Let me explain exponential curves to you with a thought experiment that will stay with you. Imagine a lily pad on a pond. The lily pad doubles in size every day. In 30 days, it will cover the entire pond. My question to you is this: on what day does it cover half the pond? Most people say day 15. They think it is linear. They think it grows evenly across 30 days, and therefore halfway is day 15. The answer is day 29. On day 28, the lily pad covers 1/4 of the pond. On day 29, it covers half. On day 30, it covers the entire pond. Half of all the growth, half of the entire 30 days of progress happens in the final single day. This is what exponential compounding looks like. This is what your dividend machine looks like. For years, sometimes decades, it feels like nothing is happening. The numbers grow, but they do not feel transformative. And then at some point, and the timing is different for everyone depending on how much you invest and how consistently and what returns you earn, at some point, you are on day 29 and everything changes. The person who abandons the pond on day 22 because nothing seems to be happening has lost everything, not because they were stupid, because they could not see the geometry of what was building beneath the surface. I'm going to give you a real number here, because I believe in grounding things in math. If you invest $1,000 a month into dividend-paying stocks with an average yield of 4% and average dividend growth of 6% annually, reinvesting all dividends, your portfolio value after 10 years is approximately $160,000. Your monthly dividend income is roughly $500. Unimpressive to most people, after 20 years, $800,000. Monthly income approximately $2,600. Better, but still not the number we are aiming for. After 30 years, $2,700,000. Monthly income approximately $10,000. $10,000 a month. From a $1,000 monthly investment sustained for 30 years with patience, the money you put in over 30 years totals $360,000. The machine is paying you $10,000 per month, $120,000 per year on an investment of $360,000. That is a 33% annual yield on your total invested capital, perpetually, without selling a single share. But you have to pay the patience tax. You have to accept years of underwhelming results in exchange for eventual extraordinary ones. You have to be day 22 on the pond and choose to stay. Most people will not pay this tax. Most people will find the waiting intolerable. Most people will be attracted by something shinier, something faster, something more exciting. And most people will arrive at 65 having consumed their seeds every winter and wondering why the harvest never came. Here is your assignment for this rule. I want you to calculate your day 30. Take whatever you can realistically invest each month, not your aspirational number, your actual number, and run the math on 30 years of consistent dividend reinvestment. Write down what the machine will produce at that 30-year mark. And then I want you to put that number somewhere you will see it. On your bathroom mirror. On the lock screen of your phone. Because on the days when the machine feels slow, on the days when the quarterly dividend feels insulting compared to your ambitions, I want you to look at that number and remember that you are paying the patience tax. The tax is real. The return on that tax is staggering. Tump. Now let me step away from the rules for a moment. Let me tell you something that has nothing to do with yield and payout ratios and compounding curves. I have been doing this for over 70 years. I have known some of the wealthiest people who have ever lived. I have sat across from men who controlled more capital than small nations. I have watched people build machines that produced income in the hundreds of millions per year, and I have watched some of them die. And let me tell you what I have observed at the end of a life. Not from books, not from theory, from watching. The man who built the machine but forgot to build the relationships, the one who was so consumed by the compounding of capital that he neglected the compounding of love, that man sits at the end with full accounts and empty rooms. I have seen men board private jets and yet be profoundly alone. I have seen women with extraordinary investment portfolios who had not spoken to their children in years. I have seen the financial machine running perfectly, producing income they could not possibly spend, and I have seen the vacancy in their eyes. Because here's the thing nobody tells you about building a dividend machine. Money solves the money problems. It does not solve the other problems. The freedom that this machine provides, and it does provide real freedom. I am not dismissing that. Financial security is a genuine gift, but the freedom it provides is only as valuable as the life you have built to enjoy it in. If you have spent 30 years building the machine at the cost of your marriage, your friendships, your children's childhoods, your health, if you arrive at day 30 of the lily pad pond and the machine is producing $10,000 a month, but you have nobody to share a meal with and no physical capability to enjoy the freedom, then what exactly have you built? The machine is a means, not an end. The most important investment I have ever made was not in Coca-Cola or American Express or Geico. It was in my children, in the time I gave them when they were young, in showing up for the things that mattered to them even when there were deals on the table. It was in my friendships with people like Charlie Munger, 60 years of intellectual partnership, that made me sharper and wiser and more alive than any investment strategy ever could. The inner scorecard I have always tried to live by is not measured in dollars. It is measured in the answer to this question. Would the people who know me best, who have seen me at my worst, who have watched how I treat the people I claim to love, would they say I was a good man? That is the only question that matters at the end. Not what did the portfolio produce, not what was the final net worth. Was I a good man? Was I a good father? Did I make the people around me better by being there? The dividend machine will take care of itself if you follow these 5 rules. Tend to the other accounts too. They do not compound automatically. They require daily deposits of attention and honesty and presence. Those are the assets that will matter most when you are sitting in a chair at the end looking back. So let me bring this home. 5 rules. The golden goose rule: your capital is a machine, not a wallet. Protect it. The dividend aristocrat standard by companies that have raised dividends for 25 consecutive years and ignore the yield traps. The payout ratio. Ceiling: do not own any standard company paying out more than 60% of earnings. The dividend is only as safe as the earnings behind it. Reinvestment engine: turn on automatic reinvestment today and do not turn it off until a machine is large enough to live on. And the patience tax: pay it without complaint. Because the growth is exponential and the last years produce more than all the earlier years combined. These are not new ideas. They are not clever ideas. They are the simple, durable, mathematically proven ideas that have produced more real wealth for more ordinary people than any exciting strategy ever invented. The tragedy is that most people will watch this video, nod along, understand it completely, and then do nothing. They will go back to checking the same stocks, reading the same financial headlines, consuming the same financial entertainment that produces the dopamine hit of feeling informed without the inconvenience of actually changing anything. Do not let that be you. Information without action is useless. Wisdom without execution is vanity. The machine does not build itself. The first share you buy today is worth more than the 10,000 shares you plan to buy someday. Start tonight. Start with whatever you have. Start imperfectly and adjust as you go. But start imperfectly and adjust as you go. But start. The lily pad is waiting, and the pond will not wait forever. That's all. Thanks for watching.